Everybody, today is Friday, the 12th of April, 2024, and this is Brian Shannon from alphatrends.net. We had a down week for the markets. Not horrible. Financials were down the worst, and they needed to come in a little bit. They're down 3.5%, trimming their year-to-date gain to 6.5%. NASDAQ and SPY are still positive, but the Russell 2000 is negative after losing so far 5.5% this month. And the cryptos got hit pretty hard. So let's take a look at these charts and make some sense of it. Here's the S&P 500, and on Wednesday I had mentioned that we wanted to have a strong defense. It seemed likely that we would come down to the 50-day moving average, is what I was saying, and we did get there, but. One of the quotes I mention often is from Linda Raschke, which is markets will do the most obvious thing in the least obvious way. And that was certainly the case for the S&P 500 after yesterday's big bounce back. I think it tricked a lot of people into thinking that the buyers were back in control. But this morning we saw a gap lower and continued right down pretty much into the close. So here's that 50-day moving average. And so far, I guess you could say it's a successful test of that 50-day moving average. But I don't think we're out of the woods. We've got too much volatility in here and a declining 5-day moving average. As I've been pointing out the last couple weeks, the quote of George Soros is that market volatility peaks at turning points and diminishes with the trend. Over the last couple of weeks, we've had a lot of volatility. While the market was going up, sure, we had a couple little pullbacks, but they were all contained within that rising 20-day moving average. And as we know, last week we lost that 20-day moving average, came down to the bottom end of this range, and we've been chopping back and forth above and below it. And now we're below the declining 20-day moving average. Next week, it should get worse because we'll be getting rid of this data. So if we get a bounce from here, I think you still have to be highly defensive in that thinking it would likely become a bounce that maybe creates a lower high and continues down to this level. And as I've been saying, I would hope for a test of the year to date anchor down near $500. The NASDAQ has been a little bit more neutral here the last 6 weeks as we've been stuck in this range here and continue to be stuck in that range. So we didn't break down in the NASDAQ, and that's thanks, of course, due to the strength in the semiconductors. But the semis are starting to show a little bit of weakness, as we'll see in a moment. Same thing. Yesterday, we had that real big reversal and then a sharp sell off today. So if you look carefully at this 30-minute chart on the right, what you'll notice is that all of these rally attempts recently have been met with pretty immediate and severe selling. That underpins weakness in the markets, and I think that it's likely we'll come down and test this level here next week in this 433 area, and then I would like to see a continuation lower down to the year-to-date anchor, as I've been saying for a couple weeks now. The Russell 2000, this market is now negative year-to-date. As we said, it's down 1%, and it is below the year-to-date anchor. So the average price that this market has traded at this year is about 199.63. So it's not just that the longs are losing money. On average, the short sellers are losing money as well because the average short seller is in the money by only about $1 though. As I've been saying over here on the 30-minute time frame, it's just a choppy mess and a market that I've been avoiding. If you look at it, you may have been better off shorting it, but as I've said, I've completely avoided the Russell 2000. To me, it's just too much of a mess. The semiconductors, they continue to hold this little band of support in here at the 220 level, and if they had lost this ground this week, I think the selling would have been worse. I still want to see maybe another little rally and then a breakdown of this anchor from this low here and then a test of the 50-day moving average. I think the market needs for that to happen, and I wouldn't buy a pullback to the 50-day moving average. I think if it touches that, as I mentioned on Wednesday, it's likely to continue down below this low, grab some stops, sucker some short sellers in, and then maybe do something like this. But For now, I think you've got to be very cautious. Over and over, I repeat, the risk management is job number one, and depends on what your time frame is. As a swing trader, for me, there's been no reason to be long these stocks aggressively, and it's been a case of lower share size and lesser confidence to handle for the extra risks. The biotechs, a new low for the not for the year, but for this move. The pattern continues to be lower highs and lower lows. This was the level that we need to get back above 93 just to become more neutral. We didn't do that. We still had, we had the market trying to stabilize, but as we say, stabilization doesn't mean you want to be a buyer. It just means wait for evidence before the buyers take control. Let the institutions do the dirty work of creating the trends. And once they've reversed and we have a real trend, then get involved and set your stop underneath a higher low. There was no reason to do that this week, and they continue down towards the level that I've been hoping we can come down to near this 26 level. That's the anchor from the October low, as well as uh, approximately the 50-day moving average, which is actually 50, excuse me, percent retracement, which is actually down closer to 84. I would still like it to see maybe a bounce in there and then continue down to last year's anchor in the 200-day moving average. There's no reason to be a buyer of these biotechs. They're below declining 20 and 50-day moving average. Just stay away from them. Financial stocks, as I mentioned, we were looking for a test of that 50-day moving average with this I'm sorry, not inverted, but this head and shoulders pattern on the 30-minute time frame we outlined on Wednesday gave us a measure to move down to about 40 and a quarter. We've undercut that a little bit along with the 50-day moving average, and now the year-to-date anchor is in sight. It only ends badly if you didn't have a plan to lock in your gains, and the signs were there. There's no excuse for holding on, especially if you purchase late up in this area or that breakout beyond the multi-year high. We knew that that was a place that was likely to get sold into. It didn't mean immediately, but it took about 2.5 weeks of distribution before that breakout was sold into. And now here we are coming down to test what's likely to be the year to date anchor, most likely early next week. Energy names undergoing a little bit of pullback in here as well. This market also breaking that all time high. So expect a little bit of profit taking for now. I think you've got to be careful about buying the dip. We saw that this was looking like a little shakeout. We spoke about Wednesday. It rallied back up, but today's failure really kind of puts a damper on the intermediate term outlook, especially while we're below that declining 5-day moving average. The bonds, let's talk about these for a moment because people like to talk about that, and lower bonds obviously mean higher yields. We've been below a declining 20, 50, and 200-day moving average for a couple of weeks now. We're below the anchor from the October low, so sellers are clearly in control. For anything to change in bond land in terms of the 10, 20-year bond here, you've got to see, just to become neutral, we've got to be back above 92 and change, and that doesn't look likely here. A little bit of profit taking, aggressive profit taking in silver. That seems overdue really for the magnitude of this rally here that we've seen just recently, about a 20% rally in the couple of weeks. So the silver market will need to digest those gains a little bit. I think gold likely as well. Let's talk about crypto, Ethereum. Oh, I have that one up here, so let's talk about that. We're right back down again to test this green anchor, which is off of the beginning of this move in mid-January, right in here. So over here it's colored blue, but right over here it's green. So never mind what color it is. The fact is, we've bounced nicely off of here the last couple times. On Wednesday, we mentioned the possibility that this meant this being a failed breakout, and that could lead to a failed move lower. Well, it tried to bounce a little bit, and here's our faster move lower. It seems to me that we will likely come in down towards that 30, 50-ish level or so. So there might be another 200 points of downside in Ethereum before they begin to stabilize. Bitcoin lost some ground here as well. It's down to the 50-day moving average that you can see in there. And I think it's most likely we come down to test this anchor off of the move that began in February. That was support back in here, and right here it's likely to be tested again. That would bring us down towards 63 even. So be a little bit careful with these things. Don't be in a hurry to buy the dips. As you know, I like to say, don't buy the dip, buy strength after the dip. I hope you have a good weekend, and talk to you later.